Welcome to Sheen Research, your strategic partner in comprehensive investment analysis. Today, we're taking a critical look at Amcor PLC, ticker AMCR. They're a massive player in global packaging, and they've just released their Q1 fiscal year 2026 results.
And these results are really foundational for the company's future. This is our first real look at a full quarter of performance after Amcor's truly transformative merger with Berry Global Group. Our mission here is to synthesize that financial performance for the period ending September 30, 2025, assess the huge shift caused by the Berry integration, and then review their capital structure and outlook using the latest Morningstar perspective from early November.
Okay, let's unpack those financials, because at first glance, the top-line figures look startlingly positive. Net sales for Q1 FY26 soared to $5,745 million. To put that in perspective, that just crushes the $3,353 million they reported in the same quarter last year. We're looking at a jump of nearly $2.4 billion. That's a 71% increase.
It's pure massive scale being bolted on.
It is. But that scale, while undeniable, well, context is everything, right?
Exactly. The vast majority of that headline growth, you're talking about $2.36 billion of it, was purely from the Berry acquisition. Once you peel back that layer, you start to see the cyclical headwinds the whole industry is facing. The underlying organic sales volumes, they actually decreased by about 3% across the whole company.
So the key narrative here is that the merger provided this huge protective barrier, masking some fundamental weakness in underlying consumer demand.
That's it, exactly. Consumers are just buying less packaged goods or they're switching to cheaper alternatives. Now, that 3% volume drop was softened a little bit by a favorable price and mix impact of about 1%.
Okay, so they were able to shift to some higher value products.
Right. It helped the average selling price. We also saw some minor tailwinds from currency that added about $110 million, though lower raw material pass-throughs did have a negative $23 million impact. So the combined company is much bigger, but it's swimming against a pretty soft economic current right now.
Let's move down to profitability. Operating income jumped to $461 million from $312 million. That's substantial. But the operating margin actually contracted, didn't it? It dropped from 9.3% last year to 8.0% this quarter.
It did, but then you look at net income attributable to Amcor shareholders, and that looked really robust. It increased 37% to $262 million.
Which sounds like a solid result for the merger.
It does, but here's the critical paradox that every investor has to understand. Despite that 37% jump in net income, diluted earnings per share, the measure shareholders actually care about, it decreased by a steep 14%. It dropped from 0.132 per TIS down to $1.13.
Wait, how does a company earn significantly more money, but each share earns significantly less? That seems to go against basic financial logic.
It's purely a structural consequence of how the Berry deal was financed. Amcor issued something like 846 million shares to Berry shareholders as part of the deal.
Wow.
Yeah, that single action increased the number of shares outstanding by a staggering 60% year over year. So while the net income grew, the number of slices grew even faster.
Which means immediate dilution for existing shareholders.
Exactly.
That completely shifts the narrative away from the top line and squarely onto the internal execution of this merger. That dilution means management has to execute flawlessly on synergies to overcome this EPS hit.
So what are the metrics analysts are using to measure that underlying core performance?
They're looking at underlying EBIT. This is essentially the profit from operations before you account for all the messy, non-cash, merger-related charges like amortization and restructuring. And that figure grew 85% year-on-year to $687 million.
Now that's a powerful validation point.
It is. And what's really fascinating here is that the adjusted group EBIT margin actually improved by 110 basis points, hitting 12%. And this improvement, this 1.1 percentage point expansion, is specifically attributed to the acquired Berry business, which just carries structurally higher margins.
So the merger instantly made the combined company more profitable on a percentage basis.
Right. Provided, of course, they can maintain that integration momentum. That momentum is what we have to drill into. Let's talk about the Berry integration itself. This wasn't just an acquisition. It was an absorption of a massive competitor.
Absolutely. We're talking about a total consideration of $10.4 billion. Plus, Amcor assumed another, $5.2 billion of Berry's debt? The effect on Amcor's portfolio was immediate. It shifted them from being heavily focused on flexible packaging to now having the global rigid packaging segment. That's hard plastics, closures, medical devices make up nearly half of the group's total revenue.
So that structural shift is the immediate win. It improves margins.
Mm-hmm.
But the long-term justification for that massive share issuance and debt load is hitting those synergy targets. What is the ultimate cost-saving promise?
The promise is huge. $530 million in pre-tax synergies. That's mostly from procurement, supply chain, and G&A functions. And they expect to realize that annually by the end of fiscal 2028.
Okay.
And beyond that, they're also targeting another $60 million in annual financial synergies and an additional $60 million in pre-tax growth synergies.
That $530 million number is the hill they have to climb. Based on Q1, how much progress have they made? Is that target realistic?
They're on track, which is encouraging. In this first quarter, they realized $38 million in cost savings. That sets them up well for their full-year target of at least $260 million.
But integrating two giants like this comes with massive immediate costs, right? You don't capture $500 million in savings for free.
You certainly do not. We saw transaction costs of $22 million in Q1 alone, which contributed to total restructuring and integration expenses of $75 million for the quarter. Compare that to just $6 million a year ago.
A big jump.
A very big jump. The total estimated cash cost of the whole Berry integration is projected to be around $280 million net. So they're spending $280 million in cash to achieve $530 million in annual savings. The payoff is there, but the execution risk is real.
Let's break down the segmental performance now, starting with their original core, Global Flexible Packaging Solutions, or GFPS.
Right. GFPS Think Food Wrappers and Specialty Films saw net sales rise 28% to over $3.2 billion, mostly from Berry's assets. Adjusted EBIT was up 29% to $426 million. But the underlying issue remains the same. GFPS volumes were down about 3%, showing that consumer restraint. This was only slightly offset by a 2% favorable price mix.
And what about the vastly transformed segment, Global Rigid Packaging Solutions? This is where that margin lift came from.
GRPS saw explosive dollar growth. Net sales soared 211% to nearly $2.5 billion, and adjusted EBIT jumped an incredible 377% to $295 million.
Incredible numbers.
But again, the underlying trend is challenging. GRPS saw unfavorable sales volumes of about 5%, even worse than the flexible segment, and a negative price mix impact on earnings of around 23%.
Hang on, a 5% volume drop and a 23% negative price impact. Sounds brutal. How did this segment still deliver a 377% EBIT jump?
That's where you see the sheer power of the merger. That underlying weakness was highly offset by the instant realization of merger synergies and just exceptional operating cost performance that contributed a massive 25% positive impact to EBIT.
So the synergies literally saved the day in the rigid segment this quarter.
They absolutely did.
This really highlights the importance of that strategic mix shift they keep emphasizing, moving towards specialized, higher-margin products.
Exactly. Because those products are stickier and more recession-resistant, they're focused on things like packaging for animal protein, specialized medical packaging, hot-fill beverages, pet food. These are segments that require specialized knowledge, and you can see it working. These higher-margin segments were a fourth of Amcor's revenue in fiscal 23, up from just a fifth 5 years before that.
Turning to the balance sheet. A merger this big always stretches the capital structure. With $5.2 billion in assumed debt, what does that debt load look like now?
It is heavy. Net debt increased to $14 billion as of September 30th. And that, of course, caused interest expense to spike dramatically, jumping by $82 million to $168 million for the quarter, all driven by the Berry merger debt.
That's a significant cost of capital. Where does that leave their leverage ratio compared to their internal targets?
The balance sheet is indeed stretched. Their net debt to EBITDA ratio was at 3.5 times as of the end of the last fiscal year, which is materially above their stated target range of 2 to 3 times.
That's a pretty big overshoot. Given that cyclical softness you mentioned, how much margin for error does that 3.5x leverage ratio give them?
It definitely raises some caution flags. Now, they are currently compliant with their debt covenants. The bank facility allows up to 3.9 times. But the path back to their comfort zone is a long one. Analysts don't expect the ratio to get back into that target range until fiscal year 2028, and that's assuming they realize all the synergies.
So deleveraging is the number one priority. How is that affecting shareholder returns?
It dictates everything right now. The progressive dividend policy is still in place. They declared the usual 0.1275 per share dividend, but share buybacks have been significantly scaled back.
I see.
Cash outflow for Treasury shares was only $22 million this quarter, down from $43 million last year. Every spare dollar is going toward paying down that debt.
Okay, let's pivot to the outlook and the risks. We keep talking about soft consumer demand. What's the forecast for recovery?
The consensus is that it's going to be slow and gradual. Higher interest rates globally mean customers are either switching to cheaper packaging or skipping discretionary purchases. Analysts don't see a significant turnaround until 2027.
And it seems management isn't just waiting around for the macro environment to improve. They announced a massive strategic portfolio review.
This is a huge piece of news. It signals they're being proactive. They've initiated a review of businesses with combined sales of $2.5 billion. That is a significant chunk of the company.
What segments are on the chopping block? I saw the North American beverage segment mentioned, which is 10% of sales. Why consider selling that right after a major merger?
It's a strategic pivot toward higher margins. North American beverage is likely their most capital-intensive, lower-margin business. The goal here is value maximization.
So, divestments or restructuring?
Exactly. They're basically saying if a segment doesn't carry the high margin Barry brought, or if it doesn't benefit from the cost synergies, they are willing to sell it to raise cash and pay down debt.
That's a clear focus on margin over volume. Let's quickly touch on the environmental side. ESG risk is a constant pressure point for packaging firms.
Absolutely. Their overall ESG risk rating is considered low, but they face immediate regulatory risk, especially in Europe. They're navigating taxes on virgin plastic and strict requirements for recycled content. Amcor is pretty well positioned, though. They reported that 74% of their plastic packaging in 2023 was recyclable, but those regulations are moving fast.
So let's pull it all together with valuation. Given the mixed Q1 results, strong underlying EBIT and synergy progress, but high leverage and soft volumes, what is the market saying?
Well, analysts set the fair value estimate at $11.50 per share back in August, but the stock was trading around $8.07 in early November.
So it's trading at a substantial discount.
A 28% discount with a price-to-fair value ratio of 0.70. This suggests the market is highly pessimistic about the near-term volume recovery and maybe a little skeptical of that synergy timeline.
To understand why this stock remains a long-term investment thesis, we need to go back to the core economic moat. Why does Morningstar give them a narrow moat rating?
It's all about cost advantage, built on two pillars: scale and location. Scale gives them massive purchasing power for resin, their biggest cost, but the really durable part of the advantage is proximity manufacturing.
The location advantage, explain that for the listener, because it's a brilliant operational strategy.
Sure. I mean, think about shipping millions of empty 2-liter soda bottles. You're mostly just shipping air, which is incredibly expensive. So Amcor mitigates this by building their plants right next to or even inside their massive customers' facilities. They're literally gate-to-gate with customers like Pepsi and Coca-Cola. That makes walking away incredibly expensive for the customer, and it locks them into much longer contracts.
That physical integration is the operational bedrock. So what does this all mean for you, the investor, looking at this stock with its 28% discount?
There's a critical tension here. You have the immediate cyclical downturn, soft volumes, high interest expense creating near-term pressure, but you have this long-term structural improvement driven by the Berry integration, niche product growth, and that unique cost advantage. Q1 proved the integration instantly improved margins by 110 basis points.
So the provocative thought for you is this: does the market's current 28% pessimism fully account for the expected $530 million in annual cost synergies that are projected to be realized by fiscal year 2028? That money is expected to hit the bottom line regardless of whether macro volumes recover next quarter or the one after. If Amcor hits that goal while shedding $2.5 billion in lower margin assets, the current stock discount looks highly compelling.
To summarize the key numerical takeaways for you to keep top of mind, we saw $687 million in underlying EBIT, which confirms the strength of the combined company. The overall margin improved by 110 basis points immediately, thanks to Berry. And the crucial target remains that $530 million synergy goal by fiscal year 2028. These are the critical factors determining whether that stock discount is a warning or an opportunity.
With that, we conclude our coverage for this video. Thanks for joining us. Sheen Research, Mindful Markets, Measurable Meaning.